In this video, traders, we're going to look at 11 economic indicators that move the currency markets. Stay tuned. Hey traders, a very warm welcome to you. Okay, so 11 economic indicators that move the currency markets. If you've been trading for a while, you know that we have an economic calendar, comes out, and some move the markets more than others. In this brief guide, I'm going to run through 11 of potentially market moving economic announcements. Now, I've written some notes on the computer because I'm not an economist, I am a trader. I know that these things move the market, that's what I really care about. But I've done some research, I'm gonna share that research with you, give us more of an idea as to why these things move the market. All right, let's start off with number one. Number one, GDP, pretty much we're all familiar with that, gross domestic product. It's just the overall economy health. In other words, how much is the economy producing? And this number, interestingly, it's quite lagged. In other words, it takes quite a long time to get all the data in. And, when I was doing my research, I recognized that actually, that's why we don't get a massive move on it, because unless it's completely out of what we expect, because the expectation is probably built from all these other numbers that we have. And so people can roughly guess, they can go, well, manufacturing's this, unemployment's this, is that. So they get a good idea of what GDP is going to be. So that's why most of the time when we get the GDP data, unless it's way out of our normal alignment, which is never normally the case, it's fairly muted. So interesting one to watch, always one to be aware of, because it's such a big barometer of economic health. It's worth looking at, but we don't often get those big moves that we get with some of the other stuff. Okay, some of the other stuff, talking about big moves, brings me quite nicely onto NFP, which is non-farm payrolls. They come out on the first Friday of the month, and to be precise, why do they move the markets? It's because the report comes out every month. And as I've mentioned here, it's linked to business cycles. So unemployment is linked to business cycles. So the reason the market moves quite often on this NFP number is because people are extrapolating that and thinking, hey, well, if unemployment is way more than expected, is that going to have an impact on the business cycle later? Is GDP going to be impacted later on? Is this a kind of warning sign that things might be changing? Of course, then they'll position in the markets. They'll be trading the anything US dollar related. Maybe they'll be trading some of the bonds, maybe they'll be trading some of the treasuries, maybe they'll be trading some of the indices. All this kind of stuff is all linked to that. So people assume they might be able to get heads up on what might happen in the future based on this non-farm payroll number. And if you've been trading for a while, you know that it's a very popular number to watch, very active. Generally speaking, you can get some crazy moves, and often you get moves which aren't necessarily crazy in one direction. They'll spike up, spike down, and it'll sit there and oscillate. But it's one to definitely watch out for if you're trading. Okay, number three, unemployment rate. Definition here for you, unemployment rate defined as the percentage of the labour force actively looking for work. So in periods of recovery, unemployment acts as a lagging indicator. So in other words, by the time we get a recovery, we've still got employment dipping, but eventually it will come back up. So this really gives traders an insight into one of the key kind of metrics followed by the Fed. Strong divergences from expectations, as any of these things, if we have a big divergence away from the expected number, is going to have a significant move on the market. If it's in line, most of the time we're not going to have a significant move. All right, number four, the federal funds rate. Okay, so federal funds rate is interest rate announcement, comes out, and it's decided by the Fed, the FOMC, and this is obviously a big thing that's going to move the market. If the interest rate changes, the value of a currency pair will change against the US dollar. The US dollar becomes perceivably more valuable as the interest rate goes up, and less valuable if the interest rate goes down. Very simplified manner. However, most of the time markets have a good idea what's going to happen. Are they going to raise? Are they going to drop rates? Are they going to hold? So again, unless it's a big surprise, markets should be relatively calm. Always worth watching. These are the ones that are definitely worth watching. Non-farm payrolls, GDP, federal funds. Because if you get a surprise interest rate announcement, that's when things really kick in, because it does reprice the value of the dollar. If it's a surprise, maybe they've hiked more than they expected or not at all, that then reprices the actual value, which causes those big moves in your US dollar, your GBP, US dollar, JPY, all your US dollar crosses. All right, number five, let's move on. Consumer confidence, and also the same as consumer sentiment. So this is basically surveying a broad section of people. I think it's the University of Michigan actually who does the consumer sentiment. they basically survey a large cross-section of people, and they say, okay, how confident are you? So you have manufacturing, you have just a broad range of sectors, and then they'll take that number and they'll publish it as basically an index number, so to see how confident people are in the economy. So that's definitely worth watching. When does it come out? Let's have a look for you. Consumer confidence comes out towards the end of the month, and the University of Michigan publishes, so it is the University of Michigan, publishes its survey twice a month. And it's a preliminary reading on the second to last Friday of the month, and then a final estimate 2 weeks later. Details that we don't really care about so much as the trader. Important thing is keep an eye on that, because if that suddenly swings, say people are suddenly more confident or so less confident for whatever reason, that could have an impact on the business cycle, which could affect the value of the dollar, which could then affect the currency pair that you're trading. All right, CPI, which is our rate of inflation index. It's a measure of cost of goods and services. It's in a basket of goods and services, and it's linked to kind of an index. There's lots of details of how it's all calculated. All we need to know is it's basically how far our money goes in terms of inflation. So we have, or the Fed will have, a kind of benchmark inflation level. If the basket of goods and services is way more, and the cost of it is way more than expected, and this comes out and the CPI number is higher, that is obviously going to have an impact on how consumers feel in terms of whether they feel rich, whether they feel poor, how much the day-to-day living is costing them, and of course that'll have a knock-on effect to their spending, a knock-on effect to the economy, etc., etc., etc. So it will impact our currency pairs. All right, number 7, Industrial Production Index. This measures the level of US output in terms of quantity of material produced rather than the dollar amount. So it's, what are the 3 areas? The broad areas like manufacturing, mining, gas, and electric utilities. Federal Reserve published this middle of each month, and it's basically, the reason this moves the market is because even though manufacturing is only like 20% of the US economy, of course, if this is an unusual number, i.e., hey, do you know what, we're not producing that much, or we're producing more than we expected, of course that's going to affect potentially the health of the economy. It's going to affect our US exports, US imports, all this kind of stuff, and so will affect potentially our currency pairs again if it's out of range of what we've been expecting. All right, number 8 is capacity utilization. This is basically how the manufacturing sector, so manufacturing kind of similarities here, although this production is not just manufacturing. Capacity utilization is if the capacity is at full steam, basically, how much capacity is being utilized in the manufacturing sector. So are they running really, really low and they've got loads of spare capacity? Are they running flat out? Again, just kind of a little bit of a thermometer on the health of the economy. And these aren't going to shift currency pairs too much unless we have something really extreme. And we're starting to get into ones here which are kind of less of an impact on the market. Not so much job claims, comes down in a second. But these, unless something specific, perhaps people are worried about manufacturing sector as a whole, and it's been something that traders have been watching. For example, we've gone through loads of cycles throughout the years, and you see traders focusing on specific angles. Hey, the recovery in manufacturing is stalling the economic growth. If that's the story, then all of a sudden these kind of numbers will come into people's radar, and they'll be watching it a lot more. Like if we're at an interest rate cycle, we're about to lift interest rates up, then people are starting to look at that. If we've got unemployment, people's vision moves. So a kind of trick that you can do without going too deep into the economics of all this kind of stuff, just to go onto your Bloomberg, your Reuters, see what traders are looking at and why. If there's a lot of story about, hey, manufacturing is really important at the moment because this and this, then you need to make sure you're watching these data points that come out that are relating to manufacturing. If no one cares about it, you've got to have on your radar because you don't get caught out by a spike that stops you out in a trade, but you don't have to worry about it too much. All right, let's move on. We've got retail sales. Pretty self-explanatory, guys. Retail sales is, it's more properly known as the Advanced Monthly Sales for Retail Trade. It's a report which basically just gives us, when does it come out? It's a division of the US Department of Commerce, and they report every 2 weeks after the month in question. So I thought it was every 2 weeks. I wasn't quite sure whether it was every 2 weeks or every month on this one, but retail sales, pretty much self-explanatory, guys. It's just an indication of how much people are buying in terms of retail. So if it's increasing, economic health is picking up, people are spending more, people are driving more money into the economy, creates more jobs, creates more profits, creates more corporations to make more money. If retail sales are picking up as well, obviously if you're trading retail stocks, you might get some kickback from that in terms of, hey, the next earnings are going to be good because the retail sales are up, etc, etc, etc. Okay, durable goods orders. This is released by the Census Bureau as part of the US Department of Commerce. Let's get some juicy information. It is basically, durable goods are defined as items that are expected to last for at least 3 years. So these are kind of expensive items that are bought in frequently. Okay, so not something that's very perishable, but expensive purchases that people will buy, not very often, but they've got a reasonable life cycle. And that's kind of the reason, is because if the demand is strong, then it means that people are, again, willing to spend, willing to kind of put more out into the economy, which could have a knock-on effect to the overall economy and could increase things. If you see suddenly a sharp slowdown and stuff like that, then it might be a warning sign that things could be on the downturn. That will affect the US dollar, that will affect the currency pairs that you're trading. All right, finally guys, initial jobless claims. This comes out weekly, it comes out on a Thursday every week. And it's for people making first-time claims for unemployment benefit insurance. This is a good one because it comes out so regularly that when the kind of jobless sector is in focus, the employment rate, the job market is in focus, you get a regular update of this as opposed to non-farm payrolls, which is kind of once a month. This is coming out weekly, and so it gives you short-term data into the changes of the labor market. And this is interesting because often you'll get kind of spikes, just unusual spikes and declines that are out of nowhere because it's weekly, because it kind of doesn't dampen out as much. Just think of like a moving average on your chart. It's kind of there, printing. You often get some surprise moves. So that's well worth watching. When things are stable and stuff, you're going to get little oscillations. But every now and then, when we're kind of at the cycle, when we're at cycle turns and we're at kind of unknown places in the economic cycle, then that's when this jobless claims number does have an impact. And you need to prepare yourself as a trader. You're either going to be out of your position, you're going to be prepared to kind of capture those spikes and falls with limit orders, or you're going to sit back, wait for maybe a trend to resume, that kind of stuff. So those are 11 economic indicators that potentially impact the currency market. Big ones in the beginning, kind of lesser ones at the end, but all will move if they are out of line of what's expected. That's the key thing here, guys. No matter what the indicator size is, obviously the bigger the indicator, if it moves a lot out of what they've expected, you're going to get massive moves in the currency market. If it doesn't, you're going to get kind of a little bit of oscillation while people pull liquidity out, and then it calms down and we're off to the races again and we're back to normal market conditions. All right, guys, see you next one. Take care. Bye-bye.